A stock goes from 60 cents to nearly $5 in less than 2 weeks. Headlines scream AI infrastructure play. Social media traders are calling it the Next Palantir. And retail investors are piling in. But here's what those headlines aren't telling you. This company has $950 in total revenue, not $950 million, not $950,000, $950 total. Today we're going to look at exactly what Robo.ai is, what actually caused this surge, and whether this is a legitimate AI opportunity or one of the most dangerous traps in the market right now. Let's start with the basics, because most people buying this stock have no idea what the company actually does. Robo.ai, trading under the ticker AIIO on the NASDAQ, is actually an electric vehicle company headquartered in Dubai, in the United Arab Emirates. It develops electric vehicles and autonomous logistics vehicles and provides mobility solutions across the US, the UAE, and mainland China. Here's the twist. The company was formerly known as NWTN Inc. and only changed its name to Robo.ai in August 2025. That name change, from a relatively obscure EV company to something that sounds like a cutting-edge AI firm, is not a coincidence. It's a playbook that has been used repeatedly in speculative markets. Rebrand around the hottest buzzword of the moment and let retail investor enthusiasm do the rest. And the financial reality? Revenue sits at just $950, less than $1,000 total. The balance sheet shows only $8,444 in total assets against $124,559 in total liabilities. Robo.ai carries negative equity and high liabilities, flagging clear balance sheet risk. This is not a company in its early stages of growth. This is a company with almost no functioning business, at least not yet. So if the fundamentals are this weak, why did the stock explode? There were two specific catalysts, and they deserve a fair look. Catalyst 1. The Neurovia AI acquisition. On May 8th, Robo.ai announced it had agreed to acquire Neurovia AI Limited, a data processing and compression technology company, in a $100 million all-stock deal. The company said the acquisition would expand infrastructure for what it calls the machine economy, where AI-powered systems increasingly rely on real-world data generated by autonomous machines and connected devices. Robo.ai said the platform would support applications including robotaxis, autonomous vehicles, unmanned delivery systems, smart cities, AI camera networks, drones, humanoid robots, and smart manufacturing. On paper, that sounds exciting. The stock surged 49% following the announcement. Catalyst 2. The NeuroStream platform launch. On May 14th, Robo.ai's newly acquired subsidiary Neurovia AI officially released NeuroStream, described as an AI-native visual data platform for physical AI applications. The company claims the platform uses a bitmap vectorization algorithm that compressed a 5.5 gigabyte 4K video to just 278 megabytes, a 95% reduction in file size, while maintaining original resolution and frame rate. Shares surged 67% in pre-market trading following the announcement. The company also announced securing what it described as a transformative multi-billion-dollar AI infrastructure partnership, which sent the stock up another 61% in a single session. So the catalysts exist. The question is whether any of this justifies what the stock has done. Now let's address the comparison that keeps coming up on social media. Is Robo.ai the next Palantir? It's worth understanding why people make this comparison. Palantir also started as a company that many dismissed. It had government contracts, complex technology, and a founder-led vision that polarized investors. and eventually it became one of the most important AI data companies in the world. But here's where the analogy completely breaks down. When Palantir went public in 2020, it already had $1.09 billion in annual revenue. It had contracts with the U.S. Department of Defense, the CIA, and major corporations. It had a proven product, a data integration and analytics platform that governments and enterprises were actually paying for and relying on for critical operations. Robo.ai has $950 in revenue. The Neurovia acquisition was paid entirely in stock, meaning no cash changed hands, from a company that itself has no verified revenue track record. The NeuroStream compression technology may be real, but it is completely unproven at commercial scale, with 0 paying customers announced. Palantir spent years building its technology in the dark before going public. Robo.ai is making announcements and rebranding in public in real time while the stock is moving. The massive run from around 60 cents to above $2 plus intraday spikes into the fours puts Robo.ai on many watch lists. But the financials are a clear warning sign. Roughly $8,444 in total assets, over $124,000 in liabilities, and only $950 in revenue. Calling this the next Palantir is not just premature. It's a comparison that could cost people real money. To be fair, there's a difference between saying a stock is a bad investment and saying it's a bad trade, and understanding that difference is critical. On the multi-day view, AIIO went from a sleepy sub-$1 ticker to a fast-moving runner. That kind of expansion in range and volume is often driven more by speculation and technical breakouts than by fundamentals. With negative equity, tiny revenue, and a stretched valuation, longer-term players tend to stay away, but those same red flags create an ideal backdrop for short squeezes and momentum chases. This is a pattern that repeats constantly in small-cap markets. A company announces something that sounds exciting. Volume explodes. Momentum traders pile in. The price goes parabolic. Then when the last buyer is in and there's nobody left to push the price higher, it collapses, often just as fast as it rose. At the same time, the negative equity and minimal revenue make AIIO highly sensitive to sentiment and overall risk appetite. Any shift in small-cap speculation could send Robo.ai sharply lower just as fast as it ran. The people who make money on moves like this are either in very early or they are experienced traders who know exactly when to exit. Everyone else is statistically buying from those people on the way up. In the spirit of fairness, let's ask, what would need to happen for Robo.ai to actually become a legitimate AI infrastructure company? First, NeuroStream would need to land real, paying enterprise customers, data centers, autonomous vehicle fleets, or smart city contracts with verifiable revenue. Second, the multi-billion-dollar AI infrastructure partnership announced this week would need to materialize into actual signed contracts with disclosed counterparties. Right now, there are no named partners. Third, the company would need to raise proper capital, not through stock issuance, but through revenue, to build out the technology at scale. None of this is impossible, but all of it is speculative, and today the stock is being priced as if it has already happened. Robo.ai is a fascinating story, but not for the reasons its promoters want you to believe. It's fascinating because it is a textbook example of how AI hype, a well-timed name change, and a couple of press releases can send a stock with almost no revenue up hundreds of % in days. Is it the next Palantir? No, not even close, at least not today. Could it eventually build something real? Theoretically, yes. But between theoretically possible and currently worth hundreds of millions of dollars in market cap, is an enormous gap filled almost entirely with speculation. If you are trading it with money, you can afford to lose, and you know your exit levels. That is your choice. But if you are buying this as an investment because someone on social media said it's the next big AI company, please do your own research first. That is what this channel is here for. Hit like if this was useful, and subscribe so you don't miss the next deep dive.